You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before we begin the show today, a couple things. First and foremost, I wanted to address something, which was I get these reviews on the podcast and they pop up on my phone. And someone left me a review. It was a 2-star review, and effectively saying that they gave me a 2-star review because despite the content being pretty good, and they called it constructive criticism, by the way, which is fine, but that the sound quality was not good, and that anyway, basically my interviewing skills with regard to interrupting people and stuff were problematic. So I don't have a problem with people having constructive criticism, and I think that is totally fine. In fact, if you have issues with sound, if you have any kind of constructive feedback for me with regard to the podcast, let me know. Email me, buck@wealthformula.com. Better yet, my editor, Phil, at wealthformula.com should know about it right away. But please don't start with this 2-star review because that's very, very irritating. I've been doing this podcast for almost a decade and have had an awful lot of 5-star reviews and good comments. And it just takes like a couple of these 2-star reviews to really hurt that record. And why do I need the record in the first place? It's not for my personal ego. So I can continue to bring people on the show like the guest that we have today. It was pretty killer. Anyway, so I would just ask you not to do that and just let us know when there's an issue. And if you would like to leave a 5-star review, please, I highly recommend, but I also would really appreciate hearing some good stuff from you. You can go to wealthformula.com and there's ways to give reviews there. Otherwise, your usual Apple podcasting, that would be nice too. In fact, maybe I'll start reading some of them once in a while. But anyway, I just needed to get that off my back here because I was getting very irritated by it. Let's talk about today's show, though, because this is a good one. And let me start out by saying this. As an introduction to this topic, I would say it is important to remember, very important to remember, that even really smart people are wrong on a regular basis. Okay? I'm wrong on a regular basis, and I'm not even that smart. But listen, I see this all the time in health and longevity related issues because I do a podcast called Sapio with Buck Joffrey because I'm into the health and longevity thing too. In case you are wondering, yes, I've become one of those middle-aged California guys trying to stay young at all cost. Not easy, but I have to admit the nerdy physician scientist type in me is having quite a bit of fun with it. And I do this sort of as my hobby. I mean, I hike and stuff like that, but it's something like we all take care of ourselves, right? This is kind of what I've been doing. And so I decided to turn into a podcast and share with my fellow Gen-Xers who are also fighting gravity with me at the same time. But anyway, getting back to the point of smart people being wrong. I see it all the time on my podcast where somebody has to be wrong because they're saying diametrically opposed things and they can't both be right. We see this in medicine all the time, unfortunately, and it's frightening, right? Because this stuff we rely on information to know what keeps us healthy. Back in the 1960s, you will recognize the development of something called the food pyramid that was hanging in pretty much every elementary classroom across the United States. I remember my 5th grade teacher quizzing us and asking us based on the food pyramid what the most healthy food out there was. And of course, he concluded based on the food pyramid that it was pizza, right? Because you had lots of bread, carbohydrates, and then you had a little bit of protein and a little bit of fat. Anyway, the point is now these days we, of course, and you may not know this, that's why you should listen to my other podcast, Sapio, but that whole model of the food pyramid is pretty much turned upside down. I mean, it's kind of, as we say in the Midwest, we say it's sort of bass backwards. And then there was a period in the 1990s where women were advised, because of a study, that was really, I think, for the most part, misunderstood or misinterpreted. That study led to, basically a generation of women being told not to get hormone replacement when it was clearly the best choice for them. And there was this fear of breast cancer because of a specific type of hormone replacement. And basically, instead of looking at that one thing, that one type of hormone replacement, it was sort of like construed as all hormone replacement in women was bad. And as it turns out, that is not a good thing for women at all. It's a hormone replacement actually ends up being a very good thing for women. Anyway, that was the advice we gave back then, and now we know it's wrong. And there was a bunch of smart people who wrote that paper. There was a bunch of smart people who interpreted that paper. There's smart doctors who gave that advice. Okay, but it's not us, not just us dumb doctors. It's it's on the economic side as well. To understand that, we don't have to go far back at all. I mean, remember, it wasn't long ago when the Federal Reserve was calling this inflation that was happening a little bit post-pandemic transitory, right? They were saying it's just transitory. It's just going to come and go. And that was just before it skyrocketed for real. So there's a lot of people over there making decisions, a lot of smart PhDs in the Federal Reserve. So how could so many smart people be so wrong? And now, of course, the Fed looks like they're delaying interest rate cuts because of the higher than expected inflation numbers. Are they missing something here? Well, my guest on today's show thinks they are. Now, this guest is a pretty esteemed economist who's made some pretty significant contributions, and he has got some very compelling things to say about inflation, that in fact we may actually not even be in an inflationary environment. It could be misinterpreted data. Anyway, it is a fascinating interview, and I hope you enjoy it. We will have Campbell Harvey after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Cam Harvey. He's a professor of finance at the business school over at Duke University and a research associate of the National Bureau of Economic Research in Cambridge, Massachusetts. He also served as president of the American Finance Association in 2016. He's written multiple books, including the New York Times Dictionary of Money Investing, Strategic Risk Management, and the latest one is DeFi and the Future of Finance. Cam, welcome to the program.
Well, thank you for inviting me.
It's very interesting to have you on at this time in our economic history right now, because you, as I understand, were one of the first people to really coin the term inverted yield curve. And we've been living in an inverted yield curve world. And I wonder if you could just explain to our audience exactly what that is and what the significance might be.
Yeah, so this is actually my dissertation at the University of Chicago in 1986. So it's a long time ago. And I was the first one to link an inverted yield curve. And what that means is the very unusual situation where short-term interest rates, like a treasury bill yield, is actually higher than a long-term rate. So usually we think of long-term rates, you lock up your money longer than you need to be rewarded for that. And that's a normal yield curve. So an inverted yield curve is where the opposite happens. It's unusual. And when that happens, it's historically been very bad news for the economy. So indeed, after my dissertation was published, there were 4 recessions. And before each one, the yield curve inverted. And indeed, there were no false signals. So the indicator is 8 out of 8 since the 1960s without a false signal. And you're correct that we are in an inverted yield curve right now and have been for the last 17 months. The time from an inversion to the beginning of a recession historically varies between 5 months and 22 months. So this is a very, very long sort of wait for an economic slowdown.
yeah, if I look back at, we're getting pretty close to those numbers, at least or past 5 months point, right? I mean, so we should be
So
expecting.
again, it's a range. So the
Yeah,
model doesn't give
yeah,
like the model does very well in terms of giving like an accurate signal before a recession. It
mm-hmm,
does very well in telling you how long the recession is, but it's inconsistent in terms of its lead time. It's a very simple indicator. Think of it, it's just like the difference between the 10-year Treasury bond yield and a 3-month Treasury bill rate. The economy is very complex. You can't ask too much
right.
from this model.
Interesting. So just drilling down on that, I mean, let's put that into sort of common sense. Why? And I can conjecture on this, but you'll do it much more eloquently than I am. But talk about sort of why it is that yield curve inversion has such predictive value. Why do you believe that does? What does it mean in layman's terms?
Yeah, so there are many different ways to approach it. But in my dissertation, and actually you can think of the following type of mechanism, that that people are worried about an impending slowdown, and they go to the safest asset in the world, and that's the U.S. Treasury bond, the 10-year bond. And what that does is it bids the price up, if people are
Right.
buying,
Mm-hmm.
and that means that the yield goes down. So that's a simple way to think about it, and that's the sort of mechanism I talked about in my dissertation. It is a little different today because the yield curve indicator is so well known. So we're talking about it right now.
Yeah.
It is so well known that it also has a causal effect. And what I mean by that is when the indicator is really known, you see the yield curve is inverted, you're a CEO, and you're not going to bet the firm on like a new project that involves taking out a lot of debt. So why would you do that when it's like code red for a potential recession coming? So you actually delay that project, and you might delay other spending decisions. You might make kind of strategic layoffs, 5 or 10% of your workforce, in preparation for a potential recession. And indeed, we've seen this. So last year in 2023, investment growth and GDP is composed of consumer spending, investment spending, government spending, and in the trade sector. Investment spending was negative year over year. And this is just indicative of companies seeing the signal and reducing that spending. So what I mean by causal is that in itself, just seeing the inverted yield curve contributes to slower growth. And this is an important insight. You might think, well, that's bad. Well, it's actually good. So these companies are more prepared for a potential slowdown. And it means that if there is a slowdown, they survive. Like what you don't want in a slowdown is a company to take drastic action to slash employment. And as soon as you do that, when you get laid off, spend profile completely changes, and we go into a spiral, and the actual downturn is far worse.
What's
So it's a
interesting,
trade-off of having some slower growth or potentially having this like bad recession. Nobody wants a bad recession.
is interesting because what I think what you're saying is that the actual knowledge of that phenomena actually could precipitate the recession itself to a certain degree as well, right?
Or a slowdown, at least.
At least slow down.
So it will slow growth as people engage in what I call risk management. And again, this is a trade-off. Are you willing to accept slower growth versus much more volatile downside?
Do you think that there are other elements to the economy right now, given all of the unusual extrinsic circumstances of the last few years, that could also change the way that particular variable plays out?
Yet let me emphasize that this is a very simple model,
Right.
and all models are wrong. So
Yeah.
yes, it's 8 out of 8, but it's not going to be perfect
Yeah.
forever. So yes, you're right. There are many other variables that you need to look at, and indeed, I do look at them. So the case for a so-called soft landing or no landing, which means a very mild slowdown that might technically be called a recession. For example, 2001, there was a recession and we didn't have year over year negative growth. We had a couple of quarters. So that is like a soft landing is ideal. Eventually, we have recession. So there will be recessions in the future, but ideally they are mild recessions. But looking at the data, there are many things that I look at that are positive for the economy. There's also a number of things that are negative, but let me go through the positive. So the positive ones, for example, we have an unusual situation where we've got excess labor demand. So I want to be clear that just looking at the unemployment rate is not that useful because unemployment is always low before a recession. And unemployment is a lagging indicator or at best coincident. And we're looking for leading indicators. But that's not what I'm talking about. I'm talking about the excess demand. So you look at the job openings and then you compare that number to the number that are seeking work or the unemployed. And there's about 2.5 million excess openings. So what that means is that when we go into the slower growth phase, which I believe we're headed towards, that it doesn't necessarily mean a big spike in unemployment. And as I said, when you get that spike in unemployment, that's bad. It's got like an effect that magnifies the downturn. So having that buffer of excess job openings is helpful. At some point, that buffer was 6.5 million. It's been reduced to 2.5. It's still a positive. So I consider this a mitigating factor that will, at best, it will, the blow will be lessened as a result of this. So that's number one. Number two is residential housing. And we remember the global financial crisis, recession, where it was a disaster in the housing market. People were very levered with mortgages, having 100% of the value of the house. And then when the value of the house went down, a lot of these mortgages went underwater, foreclosures all over the place, and the contagion that caused. So if you look at the amount of equity versus debt in residential housing today, it's a much different story. So there's much more equity than debt today. So even if there was, let's say, a 10% haircut in housing prices, that's not going to cause the same effect as in the global financial crisis because there's plenty of equity. So I think that is a mitigating factor also. So those are pretty key positives.
One of the things that you talked about is sort of the causal element of a variable that people start looking at as a predictor. And to me, as a non-economist, I look at what the Fed's been doing with predicting rate cuts or sort of forecasting rate cuts. And do you think that has something to do with the small but meaningful spike in inflation that we've seen? And is that again one of those problems where you start following the data and investors start looking at the wrong way and it has implications that you don't want it to have?
Okay, so it's a very interesting point that you make. So remember I said that there were at least two mitigating factors in terms of kind of a soft landing or no landing. And one is the excess labor demand. Number two is the housing market, the residential housing market. And I'd actually already mentioned number 3, which was the causal impact of
Right.
this indicator and people exercising risk management, kind of getting ready, getting the firm lean and being able to absorb slower growth without disrupting anything. So on the other side, in terms of risks, there are a number of them. And let me talk about your question regarding the Fed and its rate hikes and inflation. So I'm of the strong opinion, for those of you that follow me on LinkedIn, you've heard me tell the story, and it is a very, very difficult thing to actually understand. How is it possible that the Fed is fundamentally misreading the inflation rate? And let me go through the simple intuition of my point. So the headline CPI is running at 3.5% year over year. And the most important component of the CPI is shelter. So it's part of the services category, and shelter composes 36% of the weight. When you add all these things together, shelter is by far the largest component. And it turns out that the only reason that we're at 3.5% today is the shelter number. And the shelter year over year is running at 5.7%. Okay, so that is the driver. And indeed, services account for 80% of that 3.5%. And the key driver is shelter. So shelter is 60% of this reported CPI.
So rent increases, right? Rent
Yeah,
increases.
This is the issue. That if you look at real-time inflation data based upon rents, so you look at the surveys like apartmentlist.com or whatever, the year-over-year rental inflation is negative.
Yep.
It's negative 0.8%. Then if you look at housing prices year over year, and I don't care where you look, Case-Shiller or the Federal Reserve reports median housing prices, so they're flat. So you got flat housing prices, you got negative rental year over year, yet we're using 5.7% in the CPI. So I've advocated using a real-time measure of shelter inflation. And let me walk back a little bit and explain how is it possible that we're using 5.7% when that is just so far away from reality. And it goes like this. This is the story. That you are in an apartment with a lease and you get an email from the landlord December 31st saying the rents are going up 12%. Okay, so it's decided. Now, if your lease is, expiring December 31st, then you have to renew with the 12% higher, rate. But if your lease expires like June 30th, then you don't feel that 12% until June. So the shelter inflation actually works with a lag. And the Fed got into trouble with this. If you recollect, a few years ago when inflation was going up, they were saying, oh, well, this is just transitory. And I'm looking at the real-time shelter inflation, and the real-time shelter inflation was like 17% year over year.
Wow.
And I'm saying, well, this operates with a lag. It will work its way into the CPI. So the same deja vu situation is happening today. So
In the opposite direction. Yeah.
the inflation that happened in the past is working its way through the CPI. And the point that I make is that policy should be made on real time or future or expectations of the future, not stuff that's happened in the past. So, for example, there's nothing the Fed can do to pull back that email from the landlord saying everybody's rent's going up 12%. Like, that's done. So what the Fed should be doing is looking at a CPI that incorporates real-time data for shelter. And indeed, we did that prior to 1982. So the CPI today actually does reflect the experience of the consumer. As I said, it's you're off the hook if your lease expires at the end of June. So this is the real experience of the consumer. But for policy, you need to make this real time because you can't affect the past. So what I've done is I said, well, suppose we make a different assumption for that 5.7% for shelter. And your listeners probably think, well, maybe given that that rents are running negative year over year and housing prices are flat, you should use zero. Well, no, let's use 2%, which is very conservative. So when you put 2% in and recalculate the inflation rate, it is 2.1% year over year. And it's been in that range in all of 23. So inflation is only high because I believe the Fed doesn't get this key point. And their policy needs to be based upon real-time data. All of the other components are real-time, but shelter operates with a lag. So what the problem is that in 2023, all of the hikes that the Fed did were unnecessary. And if you read the minutes of the FOMC, you'll see it's mainly about inflation. So the latest release, there were 8 mentions of inflation. And to me, like 2.1%, that's your range. Like that's ideal. If the goal is 2 and 2.1, and it might even be less because I used the assumption of 2 for shelter. So I believe that the Fed has made a serious error in 2023 and in 2024 because we need to walk back those rate hikes. So we should be 1% lower today than where we are. And this is important because these rates are very important for investment decisions. So it's kind of obvious that if the mortgage rate goes up, then it's less likely you're going to like buy a new house. And if the interest rate goes up, it's less likely that a company is going to finance a major new investment. They will say, no, it's not worth it. So there is this really important relation between rates and the intensity of investment. So I believe that the Fed has made multiple mistakes here in 2023 especially, and in 2024. And what they've done is actually increase the probability of regular recession or a serious recession.
Yeah.
So if we want to dodge a recession, I think everybody wants to dodge a recession. Nobody wants a recession. Indeed, people say to me, oh, well, don't you want a recession because your model is saying there's going to be a recession? I said, no, you got to be kidding. So I don't want a recession. Nobody wants a recession. And the Fed, in being very stubborn and misreading what is hopefully like really intuitive, misreading inflation has actually increased the chance that we get into serious economic trouble.
So, Cam, would it be fair to say that based on this, for reference, it's interesting on my group because we are apartment investors. We totally see we do not have that kind of growth in apartments right now, right? It is, where I think 2% is 1 or 2% is probably very reasonable about where we are. But if the Fed is using this in their numbers, and that is essentially what they're using is kind of, lagging numbers, would we expect to see a big drop in CPI over the next 6 months based on that assumption?
Exactly. So CPI is heading down. It's easy to forecast. So when this very large component is operating with the lag, then it's easy to forecast where we're going. And within the next 6 months, we're easily into like the mid 2 range.
Interesting.
So again, that's the sort of thing that the Fed should be looking at. The Fed has 400 PhD economists. So why is it up to me to make this point?
Good point. This is absolutely fascinating. So how do you see this playing out? I guess So now a few months goes down the line. The Fed continues to probably are going to hold on the June cuts because of this data that they just recently saw. So that's going to continue to potentially scare business owners a little bit more. And then 6 months down the line, you see this precipitous drop in CPI. Hopefully you don't hit a recession. Is that effectively what your suggestion is? Maybe is what they're doing right now could result in a recession, and then boom, out of nowhere in 6 months they're going to say, "Wow, CPI dropped," and wonder how that happened.
Yeah. So we hadn't really talked about the risks other than the Fed policy. So the Fed policy is not helpful. It's the opposite. So that's an obvious risk. There are other risks. So let me just go through a few of them. Number one, the reason that we had 2.5% real GDP growth in 2023 was consumer spending. And there was a good reason for it. Some of it is pent up COVID demand. Some of it is very generous government programs. Just look at the deficit and how it exploded after COVID. Look at the Fed's balance sheet to see how it exploded, tripled after COVID. So given this extra money that went into savings accounts, that was spent in 2023 and indeed also in the first quarter of 2024, and according to my forecast. So at some point, the savings run out. And for example, the savings rate today is 1/2 of what it was before COVID. So I think that it's unlikely that we will see robust consumer expenditures in 2024, that like the second half of 2024, and I think that is definitely a risk factor. Number two risk factor is I said residential real estate was in good shape. Well, commercial real estate is not. So we've got like record vacancy rates. San Francisco is like 36%. And all of these loans are linked to mainly regional banks. They need to be renegotiated with much higher interest rates. So that is very fragile and is definitely like a negative, something to be worried about. I mentioned the regional banks, but I think that there's another factor. It's very subtle, but I think intuitive. So I was one of these naive customers at my bank that didn't really track the interest rate on my savings account until I did. Mm-hmm. So we know that you can get more than 5% on a money market fund right now. The average interest rate paid in a savings account is 0.5%, 0.5%. And that's the average. So if you look at the too big to fail banks, you will see savings rates that are much lower. So 1 basis point, which is extraordinary. There's one too big to fail bank that offers 5 basis points. So that's 0.05%. So think of it, it's like 100 times lower than what you can get in the money market. So what do people do? Well, I'll tell you what I did. I yanked all my money from the savings and put it into a money market fund. So think about what happens. And it's very intuitive. So the bank had my money. And what does it do with that money? Well, it sends 10% to the Fed as a required reserve, and then it lends it out to businesses and to consumers. And when I pull that money out and it goes to a money market fund buys treasury bills and things like that. So they're not investing in loans. So what that does is it takes credit out of the system. So there will be a credit crunch, which means more difficult to finance these loans for businesses. And it operates with a lag. So we haven't seen it yet, but it's another thing that operates with a lag.
So if you had to bet, I'm just going to, and I know economists don't really bet on this kind of stuff, but if you had to bet based on all the things that you told me, it sounds to me like you think there's a pretty good chance that we do end up in some recession because of essentially policy driving it there.
Yeah, so my view is more along the line of a soft landing. So my model actually doesn't just predict recessions, it predicts growth. So there's a scenario, which I think is the ideal scenario, where growth does slow, and maybe there is a technical recession, but hopefully not a serious recession. So I think that this soft landing scenario is feasible. But what I worry about, and this soft landing could be, the probability of the soft landing or a no landing would be greatly enhanced if the Fed started to cut rates, like now.
Fascinating stuff. We didn't even get to the central bank stuff, the central bank coins that we're going to talk about, which I would love to have you back on at some point. To discuss, Cam, but this discussion was too interesting for me to move on. I want to thank you so much for being on, and again, hopefully we'll have you back on. The latest book again, though, does have to do with DeFi, which I'm eager to get your thoughts on too. It's called DeFi, the Future of Finance. Thank you very much for being on, and looking forward to talking to you again.
Very good. Thank you for inviting me.
We'll be right back. Welcome back to the show, everyone. I don't know about you. I thought that interview was fantastic, though. I mean, I felt a little bit like I was in, Campbell Harvey's economics class, which I kind of enjoyed because I was kind of nerding out a little bit. But fascinating stuff. And when the way he explains that situation with, the lagging indicators of rents versus, the reality. I mean, it just seems so clear as day, right? It looks like, man, yeah, they are missing something. Just like they missed it when they called inflation transitory, when rents were going at double digits, and we were enjoying that as apartment investors. At any rate, really interesting stuff. Hopefully, you enjoyed it. And just a reminder, once again, that you can join our investor club at wealthformula.com. Make sure you consider doing that if you're interested in seeing some opportunities. Real estate is going to get hot again at some point here, but there's lots of other things going on as well for you to consider, such as, our aviation fund and some other things that are coming up in the near future. That's it for me this week on a Wealth Formula podcast. Make sure you give us a 5-star review if you are liking what I'm doing, and we'll see you next week.
Thank you for listening to the Wealth Formula podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.